I'm super excited to welcome a very special guest today. He is the head of the due diligence of the FORBES Family Trust and co-founder of Meritas. He joined Optima, which is now acquired by Forbes, in 2011 from Arden Asset Management, where he managed due diligence for several multi-billion-dollar hedge fund portfolios. Prior to Arden, he spent 5 years in government as a financial crime investigator for New York State. He started his career at Salomon Smith Barney, working in trade settlement and operations for one of the most active investment banks at the time. Now, talk about diversity. He started and founded Sigma Beta Rho Multicultural Fraternity, which remains till date one of the largest multicultural fraternities in US. Welcome to SheVC. I'm your founder and host, Gayatri Sarkar. A very special guest, Datta. He is the head of the due diligence and he's managing the investment of Forbes Family Office.
Hi, Gayatri. Thank you so much for the opportunity. I'm a big fan of your work and excited to chat.
I just want to ask you the very first question. Like, you had been an investor for over 20 years, starting out at Smith Barney and now at the Forbes Family Trust. How has your public market investing experience shaped your investment theses in the family office business?
Great question. I think in banking, typically you're working with large pools of capital and you're very highly regulated. So I think by default, that typically limits your options, both in terms of how you can invest and where you can invest. So at least for me specifically, moving over to alternatives, typically hedge funds, private and venture capital, kind of in that alternatives bucket. For me, it was interesting because we continued to manage large pools of capital, but now we had flexibility to be creative in our investment strategies while still focusing on providing superior risk-adjusted returns.
Currently, you're head of the due diligence. What are your investment focus from Forbes Family Trust?
Sure. So I think, like a lot of institutional investors, our family office is cautiously optimistic, I would say, both on the short term and the medium term. I think even before COVID, we were concerned about valuations and we were concerned about the markets being at all-time highs and a 10-year equity bull market. So, prior to this, we were looking for strategies actively that were non-correlated to S&P, non-correlated to broad equity markets, and just kind of have more kind of defensive in nature and provide some zig when other funds are zagging. One recent initiative that I think potentially is timely with COVID is that January 1st we launched a healthcare fund, which is focused on biotech, pharmaceuticals, therapeutics, and that also has been interesting these times. And one thing we look for consistently is edge, and I think in the healthcare space, a lot of the folks continue to have some edge and alpha capability.
No, that's amazing. So since you're talking about healthcare, COVID-19 is disparaging not only United States, it's all over the world. And obviously you're seeing there are different kind of fund managers coming to you. Right now, everything is on Zoom. We cannot meet people in person. So let's talk about the fund manager selection. What qualities do you look for when you're looking at fund managers?
We're looking for alpha. We're quite active investors, and we invest across strategies, across geographies, across size, and different types of asset classes. So I think having a diverse mandate is helpful for us. So structurally with managers, what we look for is someone that has a unique edge and has a process that's repeatable. So being able to articulate how they got their returns, being in a position that, okay, this is how I got here, and this is how we expect to continue to make this return for us. Because as we're as big investors, we have multi-manager portfolios. So each specific allocation has a real specific role, and our managers typically are meant to fill a specific need.
That's great. And so talking about fund managers, obviously there are tons of emerging fund managers. So do you invest in emerging fund managers or first-time fund managers? And would love to know your diversity mandates. in your investment?
Sure, sure. So our founder Dixon Boardman, he makes a comment that he likes to avoid weddings and funerals, which I think is a good way to think of it. So we're typically not day one investors, and we don't like to be around when things are when the wheels are falling off. But that being said, we do occasionally allocate to smaller emerging managers. It's a little bit challenging for us given our size. So we would want to be 50% of a fund's AUM. And so, finding the relationships that are obviously work for the type of mandate we're looking for. But if there is somebody that we think is a supreme talent that may or may not have the infrastructure or even AUM to support what we're looking for, we have on occasion just open managed accounts. And that's interesting because in a case like that, we may believe in somebody's talent, but for one reason or another, they may not have the infrastructure or the team or the systems in place to be able to support the type of capital we want to give them. So in a case like that, we'll say to them, we'll set up the account, we'll give you control to be able to trade, and then we'll control cash, we'll control custody, we'll take all the headaches out of your seat, and you just focus on where you're good at making money. So we on occasion will do smaller startup managers, but it really has to be a compelling opportunity.
No, that's good to know. I think the audience that we have for SheVC are diverse fund managers, experienced fund managers, but also emerging fund managers. So do you see non-institutional investors moving into later stage investing since the small cap public equity marketing is shrinking, and how can they do that? And also I would love to know your take on approaching the liquidity, because many families may be averse to illiquid positions, especially during these uncertain times, and we have seen that also. So I would love to know your take about this current market and the liquidity position.
Sure. Yeah. So on the cap side, I think, for us being long-term investors, we used to have dedicated small cap managers, dedicated, kind of earlier strategy managers. And it's just tough. I think it's a space where it's tough to consistently make money, managing small cap stocks. And, to the extent we've had relationships like that, they typically haven't lasted that long. And it's just a function of, you're right, there's people are surprised to know that the universe of investable stocks in the US hasn't increased. It's decreased by roughly 50%. So there's more money chasing less stocks, and just by default, it's going to push everything up.
Yeah, and I would love to know your take also on the liquidity position.
Sure. So on the liquidity front, it's interesting because you would think that especially what's going on in the market, folks like us would be hyper focused on liquidity, and liquidity actually has not been our focus. We're more focused on alpha generative strategies. I think we're actually looking at less liquid strategies to the extent we could take advantage of current dislocations. And a current example of that is, there's a lot of discounts in real estate and even things like nursing homes and things like that. There's hotels and travel. A lot of these assets are at all-time distressed prices. So I think to the extent you have the window, if you can wait 5 years or 3 years or 7 years, some of these names can play out. And I think us being long-term investors, and anybody who has a long-term horizon, shouldn't be necessarily panicked and potentially taking advantage of this time.
Yeah, I think you kind of answered my next question, but I would still love to know, since we are talking about COVID-19, has your risk profile changed over years, especially more recently during COVID-19?
I wouldn't say the risk profile's changed. I would say that it's gotten different. And what I mean by that is, we're looking for different strategies or different kind of profiles of managers, if you will. And one thing that's interesting is us being such an old kind of legacy organization. One thing that's interesting for us is we're transitioning away from some of these bigger, well-known, $20, $30 billion asset managers who we've had, some cases had relationships with 25, 30 years. Folks like that, I think a lot of people are thinking, hey, where's the alpha going to come from? And a lot of folks, and me included, the belief is that the smaller, more nimble, more agile managers will be in a better position to capitalize on some of these opportunities. So I would say that not our profile hasn't really changed, but our thinking and our ability to deploy capital and maybe focusing on being nimble more so than kind of risk.
I would love to like go a little off the track. We discussed before about this, like, you know, you look at the hedge fund model, you look at the asset management model, and things are changing now. And, you know, we are definitely talk about, you know, the virtual portfolio management opportunity that you have created in the software technology side. But so suppose if Cliff Asness, if a young Cliff Asness or Ray Dalio or Alan Howard walks into your office for fundraise, how do you measure their performance, their track record? They're like 25, 30-year-olds with no track record, basically, as a fund manager.
You picked three interesting examples because we know all three of them super well, and I've had money with all of them at one point, and it's interesting because I would argue that those strategies, you know, the quantitative, the data intensive strategies are the hardest, or they're the highest barrier to entry to do right now, right? I still see value in fundamental long-short equity investing. I still see value in folks that do deep dive fundamental research and decide what side of the trade they want to be in particular companies. However, when you're talking about statistical trading and high frequency trading, in my opinion, a lot of this is an arms race, in the sense that you're not going to outspend Millennium or D.E. Shaw or Two Sigma or Renaissance or folks like this who literally have unlimited budgets and armies of programmers, and you're somebody like a young Ray Dalio or Cliff Asness starting out right now. They quite honestly, it's very difficult for them to compete fairly. So I would say it's someone like that coming into the office right now, that they would need to have a real unique model to do something different that other folks are doing. And it goes back to being nimble again, because again, look at Renaissance, with unlimited capacity and unlimited resources, there's still plenty of markets they can't trade in because they're just too big. So folks like that, being smaller, like you won't have much computing power, but you may be able to do things they can't do. And that for us is interesting.
That's amazing. I love that take. And now coming back, I think it's a natural progression to talk about what you guys are building. You're also a founder of Meritas, a virtual portfolio management app for college students. So can you talk about the meritocracy factor that is built into the algorithm, and that may help a young Cliff Asness or or Ray Dalio to build their portfolio virtually, and how you guys are democratizing long-short equity portfolio management?
Sure. Yeah. So as I was saying, we still believe there's a lot of value in long-short investing, and one thing that we know as being professional investors is that there's a lot of copycat investing going on in the industry, right? Folks are buying the same research, doing the same kind of analysis to it, and picking the same stocks. And we see that as investors because we invest in 10 different hedge funds or 20 different hedge funds, and they have the same performance time and time again. So, myself and my partner Gabriel, we both felt that, there's this opportunity that younger folks and students and particularly university students are in this position where they're typically on the forefront of consumer trends, right? So they know what's cool, what's not cool. And, if you think of, specifically college students, typically they're taking finance classes, they're doing equity research, but then they graduate and there's no mechanism for them to even, keep track of their performance or monetize any of their work. So we wanted to kind of create it for them. And that's what we did. And Meritas basically is a platform where anybody can join. You log in, you create a free account, and it's gamified trading software, kind of, Tinder meets Bloomberg, if you will. And we kind of get students to learn how to trade by, going long companies you believe in and shorting companies that you think are not situated well or not, kind of in a position to succeed. And that's not that dissimilar to how we build portfolios. We long companies we believe in and short the other ones. And I think at a high level, we're creating this almost global NCAA for Wall Street, such that it doesn't matter where you are, what you look like, how connected you are. You could show your skill set, learn how to trade, and we give out cash prizes to the best users. And probably the most compelling piece is we have a job board. So we have jobs from hedge funds, asset managers, banks, and we allow them to hire based specifically on talent. And that is unique. And we allow them to pick based upon portfolios and tracks, not just a standalone resume, which obviously perpetuates things like gender bias and unfair pay practices.
Yeah, totally agree. I would love to a little bit more know more about the Meritas. So when you talk about the data, the recruiting, can you talk further? Because suppose I'm, again, I'm taking Cliff Asner's example. I'm doing my PhD under Eugene Fama. He's a Nobel laureate. He is working on, walking on the Wall Street. All the thinking the economic agents are rational, and I'm working on the behavioral side of the economics. And if I look at Meritas, how it's going to help me to build that portfolio, and also Cliff went and worked for Goldman Sachs, and how Goldman Sachs is going to take that data and found out my meritocracy towards the public equity investment. So would love to know that factor too.
Sure. And it's an interesting example because Cliff worked at Goldman, but what if you can't access Goldman, or what if you're sitting in India or China or Africa? And I think that's really the compelling argument, right? Let's create a virtual environment where anybody globally can just join and start trading in a realistic way and start managing a portfolio in a realistic way, such that it's an academic exercise. And using your example, if a young Cliff Asness or a young PM starts trading, even if using your example, if a person goes to Goldman Sachs and works there for 2 years and they want to go work for a hedge fund, they probably can't take their track record with them. There's no proof statement that they know what they're doing. So we're effectively creating this mechanism where anybody can create a track record for themselves and give the world proof that they know what they're doing and they should be hired by your hedge fund or your bank or your asset manager. So that really is the concept, that we wanted to really create this online meritocracy where we took out all the friction and took out all the kind of the inherent biases that exist in terms of recruiting and hiring and resume bias and things like that.
I think there are a lot of people who will be reaching out right now to know more about it. What is the website, or what is the app name, if you can just talk about it a little?
Sure. The website is meritastech.com, and the app is Meritas Tech. And we are active at the top universities in the US right now, with plans to expand globally, and we're super excited.
That's great. So I cannot believe you're coming almost to an end. I'm going to ask you my last question.
Sure.
You have been involved in investment, from the financial side. You're looking at so much towards the investment side on the other, other side of the table. And at the same time, with this app that you're building that is democratizing, how we look at the public equity market investment. I would love to know how you're managing your work-life balance. You have 2 kids, and we were just talking about doing this podcast. If one of our kids is gonna, walk in, so how we are gonna manage that. So it's a nonstop job, and nowadays the work-life balance have blurred further during COVID-19. So would love to know how you're managing work-life balance, and have you acquired any new learnings during this time?
Well, it's interesting. The funniest quote I heard, I think I saw this on Twitter, was we went from working at home to living at work. And I think that's a fair statement. And I have 3 kids under 10, and they're constantly looking for engagement. And I think that's, as a parent, you have to really decide, especially these days, decide that, okay, I'm turning it off now, disconnect, and more so than ever, unplugging is important. And I think, especially employers and people expect, people instant responses and emails and instant response to texts. And I, as professionals and investors, it's important for our sanity to just be unplugged for a while, turn everything off, recharge the batteries, and potentially be, once you come back from that, typically, hopefully you come refreshed.
No, that's great. So thanks a lot, Neil, for your time. And we are super excited to have you. And I think there will be a lot of people who will be reaching out to you, not just for investment, but also to know about Meritas.
Thank you so much. I appreciate the time, and I look forward to talking again.